Good afternoon. I have now listened with a lot of interest, and I have to talk about the very boring stuff, which is long-only, primarily investment. What do our clients actually want from us? And it's really difficult these days because I've been hearing with a lot of interest this morning, all the sessions we've been hearing, the more optimistic views, the more negative views, the views on panics, the black swans, how are we going to be looking at the future? In my case, what I have to come back to is going to my clients who 90% of them are institutions, primarily in Europe, pension funds, life companies, who are asking me, what do we do next? Where do we go in 2009? What do I do with my investment portfolio to either meet my liabilities or exceed returns so I can pay my pensioners? And currently it's really difficult, and we're trying to have those discussions with them. Let me share with you how we go about it. One of them, and just before I start talking, you will see that I have a strong bias towards emerging markets, generally in Asia, particularly. I've been living 8 years in Asia Pacific, so that might help a bit to the bias. But I'm trying to do it a bit more than only by the fact that I've been living there. I think we have a few slides there. Oh. Did you catch up how it went up? This one goes up. Okay. Well, it's really unfair what's happening to emerging markets, if you think about it. If you think all the work that emerging markets have done since the Asian crisis to today, and how the fundamentals and the structure of their financial system, and even their governments and the regulatory environment has improved, and the fact that even in October, January, and May, some of the markets, the BRIC markets, have seen the all-time high in their stock markets, how this has come to a very sudden and an abrupt sell-off. And the main reasons for that, no surprises, is the sudden risk aversion from Western investors, the abrupt deleveraging, and the repatriation of funds, which has been this massive sell-off where I think the last data I've seen is that for the BRIC countries together, we've seen year-to-date 65% decline in their stock markets. So what's driving us currently? Well, many of you maybe know this chart, this cartoon. It's quite old. It was actually done in 1987, but it's still quite applicable. This is the panic that, Michael, you mentioned today, this morning. This is the panic of our very educated brains, our top talent in the financial sector. Currently, in this sort of environment, it's impossible to make a rational investment decision. And that's, I think, one of the key lessons that that we're learning ourselves and that we're trying to give to our clients. I know it sounds very cheesy, but it's really true. It's about long-term and fundamentals. If I'm a pension fund, by the nature of my investments, I have a longer-term view. So by the nature of my investments, I need to make sure that I take certain positions with trying to take that long-term view. And the long-term view is that, yes, the economies and emerging markets have taken a beating. But again, it's been a beating mainly for 6 months, for the last 6 months. We've heard a lot today about growth and the fact that the IMF is still predicting growth for 2009. And it's still predicting some pretty reasonable numbers for emerging markets, or China in particular. Yes, you can say that it's a problem if China falls below the 8% growth line. But still, the forecast is between 7.5%. That's, in any market, it's a pretty decent number. And as I said, we also heard this morning, I think, Chris, it was in one of your first charts this morning, that demographics help in emerging markets towards long-term fundamental growth of those economies. So I've put a few busy charts that bear with me because you've seen most of them from my other much smarter and economic-based speakers this morning. The story on the left-hand side of the slide is that the role of emerging markets over the last decade has grown significantly as part of the world's economy. I completely share the view that decoupling was a nice story, and it helped a lot when we were pushing a lot for emerging markets investments, because it helped a lot of saying almost like I wouldn't say a negative correlation, but it would say it was a risk diversification towards global equity. That didn't quite work. So now we're back to the drawing board saying, yeah, decoupling was a nice marketing story. Didn't work. Take that one. What we're saying, though, is, yeah, it doesn't work, but still, the economic fundamentals of that region in general, let's call it emerging markets, although we all know that they're very different one from the other, and that it's very dangerous to speak of one topic. But just for the ease of time, I only have 10 to 15 minutes. Let's speak about emerging markets. From an economic, from a social, from a savings rate environment, they're poised to have growth. The market capitalizations of many of the stock markets in the emerging markets are still incredibly small compared to the role of the GDP of those economies. The rate of family-owned business in those economies is still incredibly high compared to other more developed markets. The degree of an income-winning middle class in some of those countries is growing quite substantially and is pushing, as the generation goes from the entrepreneurial father to the maybe somewhat more wealthy, educated son who's not that interested in taking over the company of the father, into a push to developing those companies into stock markets and bringing them out to the markets. And though it's sad to hear the low numbers of IPOs, still you're seeing that trend in Asia being the driver of IPOs. In Spain, by the way, it's a very similar case. In Spain, 80% of the industrial sector is medium to small-sized companies and family-owned. That push into the listed market, that push into the IPO market, will, over time, allow a more sophisticated, more deep investment universe for investors to choose from. And that's not only Asia. Here I'm talking emerging markets in general, and, for example, one of the regions that is most underdeveloped in that area, which is Africa, where we're seeing a very early start to that deepening of the investment universe. So, how do we talk to investors? Well, there's always been a sort of an urban legend that as long as the dollar is strong, emerging markets will not perform. And if the dollar weakens, emerging markets will perform better. Well, today, as I said, one of the things we're watching in that cartoon is the dollar against everything. The dollar has been a roller coaster over this year, and it's very difficult to watch it and have any sort of idea of what to invest in. What I did on the left side of the slide is to try to give you a bit of perspective since 1997, what some of the Asian key stock markets have done and where we're going through it now. And as I said, really what's unfair to many of these Asian markets is that they've done a tremendous work until 2007, and that a lot of what's happening to them right now has really nothing to do with them. Now, here again, I'm talking more about Asia. Many of the situations where you're having now, really, you could call it beginnings of the recession coming through in many of the Asian markets, is not of their doing. It's suddenly the consequences of the stress of their financial markets, the stopping in the developed world of export demand, and the fact that the growing middle class, the growing domestic demand in those economies, which was the great new factor which made emerging markets different from pre-97, is not yet strong enough to make do for the lack of export-driven demand. That's why globalization indeed has won by a mile. So what we'll be needing to watch, we'll definitely be needing to watch China and India. I saw, Carlos, what you said, that China cannot do this alone, but it's a great indicator. It's a great indicator of how the world economy is doing. Almost, you could see it as a proxy these days. And watching China's growth over the next year will be one of the key parameters that as an investor we'll be looking at to see when to go back selectively into Asia. We'll also be looking into India. We'll be looking to India as the second engine of growth and seeing how they develop over the next 12 months. We don't think, by the way, that any of the recent very horrible events in Mumbai is going to have any meaningful medium to long-term impact on India. The increase of savings rate, which we see all across Asia, and the development in certain economies in Asia, like Korea, like Taiwan, of a strong culture of wealth management, will be another of the driving factors of those economies, those stock markets, sorry. this savings rate has to go somewhere. I think you mentioned earlier this morning the lack of a social safety net in many of those markets. The savings rate will have to go into a level of investments because cash or putting it under the mattress will not be a good alternative. So that strength of savings rate for us is a positive in the medium term. And also that the financial sector, let's face it, the Asian banks are in a much, much better shape than the Western counterparts. I mean, one of the latest exports of the Chinese economy has been the Chinese banking model. Now everyone in the US is the same, or in the UK, is like a Chinese bank. It's half owned by the state. So the Asian banks, because they've adhered themselves to a much more traditional banking system, deposit-rich banking system, are in a much better shape. Yep. So the investment case. The investment case, and I really put the cartoon up because in this environment, honestly, it's my best guess. And you have to be frank about it. You have to say, if anyone can predict what's going to happen, he would probably be a very wealthy person, because I don't think that anyone in this room has seen what we're seeing currently ever before. So we're going, to a certain extent, in uncharted territory. The guesses we're making we are basing them on what we think an investor has to base it on, which is a long-term view on the fundamental drivers of a region, of a country, of a sector, of a company. And there, Asia, particularly emerging Asia, is, in our view, still a winning case. You have markets that have come a long way with fiscal stimulus, with much better corporate governance. You have savings rates, you have fundamental economic growth, you have a better banking environment, you have better, now stronger regulators coming through, and you have a strong and growing middle class in some of the Asian countries, which are driving consumption. So I completely share your view that consumer goods is an area that we will be looking quite thoroughly at. We'll be also looking a lot, and again, I share the view with you, everything that has to do with infrastructure and government support. Sorry, this thing is just better. So any sector related to government spending in the Asian markets will be something that we will be looking at. But the only way that you can invest in Asian markets is if you're a European institutional investor, if you have at least a 3 to 5 year view. For the next 12 months, it's going to be very choppy. We do not expect any upturn in the markets which is sustainable, at least until 2010, maybe last quarter 2009, not beforehand. So definitely a longer-term view. But let's face it, Asia is still attracting money. Now, I don't know if many of you know a lot about the outflows in Europe in mutual funds. That's my day-to-day life, so I watch it quite carefully. Europe has had dramatic net outflows in mutual funds in 2008. Spain has been really savaged by outflows. In Asia, it's still net inflows. It's still $10 billion in net inflows going into Asian products. So you're still seeing investor appetite to go into Asia. The appendix is quite boring and macro, and you've seen many other charts. So in conclusion, what we are telling our investors is that the topics you have to concentrate on are emerging markets above Europe. Within emerging markets, we particularly have a preference for Asia. We're looking at infrastructure-related sectors and consumer goods. We're looking definitely at climate change-related, and not only as a concept of clean tech, but we're looking at climate change as the fact of life of climate change. There will be industries that are not trying to reduce or slower the impact of climate change, but will benefit from the fact of climate change. So that's another sector we're looking at. And one of the key topics that has been developing, and it's been driven out of Europe, and is now starting in the US, and is progressing in Asia, is corporate governance, where boards of companies are starting to see the importance of corporate governance and how investors are starting to drive in AGMs and in votings that the boards start to address some of the concerns from a governance perspective. That's something that European investors have been very, very strong in, particularly the Dutch, to a certain extent the British and the Germans, and that's now developing extensively in the US, where 2 years ago it wasn't a big topic, or in Asia. That's really it, but share with you my frustration of not being able to give any sort of clarity as to what investors should be doing right now. Thanks.